Hey, what's up? This is J. Lucky Henry. So today we're going to talk about the four things, well, they're not the only four, but there are four of them that lenders look at when they're setting a fixed rate for you on that mortgage. Get ready. They ask me how I know it'll be okay. This is J. Lucky Henry, Keller Williams agent in the greater Boston area, and I want to help everyone get real. REAL. Real estate explained amazingly by Lucky in 90 seconds, give or take. Welcome back, it's J. Lucky Henry. So we're discussing four of the things that lenders look at. Now, there may be more, but these are four core ones that they look at when they're setting the fixed rate for that mortgage you're gonna get, okay? Number one, they look at your credit, right? We know that. That's why we always are preaching in the American culture to work on the credit, because the credit is power, right? So they look at the credit score and see what that's like. That's gonna help be part of the determining factor. Another thing they look at when they're setting that fixed rate is they actually look at the income. Like, how much are you making? Can you pay back this loan over the course of time? And speaking of time, that brings us to number three, which is the actual length of the loan. How much time are you trying to borrow this money for? Because the longer you want to borrow it, the more chance something could go wrong, right? If you're going to pay it back in 10 years, if you're going to pay it back in 10 days, like, that's really quick. So you know it's going to happen quick. Over 10, 20, 30, 40 years, something can happen in that time. So the length of time also plays a factor in what type of fixed rate you're going to get. Now, the other factor that plays a hand in the fixed rate that you're going to get, beyond the credit score, beyond the income, beyond the length of time, is the LV, right? The loan to value ratio. So if you're borrowing $100,000 for something that costs $150,000, right? The value is $150,000. You're getting you're only borrowing $100,000 of it. So that means you either put down $50,000 yourself, or you're getting $50,000 because you bought it for a good price. Either way, you've got some equity there. So the loan to value ratio is very important. Does the bank basically feel like they're taking all the risk? And this thing cost $150,000 and they got to put out $149,000. So if you walk away from the deal tomorrow, you're losing $1,000, they're out $149,000 and own a property that they had no interest in owning in the first place. All right? That loan to value ratio, your income, your credit score, and the length of time are four of the core factors used in determining your fixed rate. Now, we talked about fixed rate. Just to be clear, what a fixed rate is. The fixed rate is a loan that stays the same for a certain amount of time, either throughout the entire life of the loan or for most of the loan, just to make sure we cover that basis. So it's been real. It's been 90. Gotta go. We'll be back tomorrow with another video. This is J. Lucky Henry, and I'm here to keep it real with you. Whether you're looking to buy, sell, or invest in real estate, call or text 978-712-0244 and make sure you subscribe to my channel for more.